Perfect. Okay, welcome everybody. So today we're just going to take a few minutes. We've asked some personal questions to a bunch of individuals. So one of them was, what is the difference between mutual funds and stocks and investing and gaining clarity around that? Another was, being a sole proprietor and working in different provinces, which is more of a tax question. That'll be for Friday. And the other one is when you have a corporation, just getting clarity again one more time on how that actually works. So I'm going to just start off just quickly addressing and just drawing this picture out, sole proprietor versus corporation. And I mostly want to speak to the corporation part. And that was for yourself. And that was basically like explaining that when you get paid as a corporation, because I think they don't explain this enough when you set up a corporation. Essentially, what happens is the corporation is like think of it like someone else's bank account. So money is getting paid to someone else's bank account. And then anytime money gets taken out, there must be a paper trail. Okay. And so, a lot of times when, we get our corporation, we're like, well, I worked, I made the money, it was paid to my corporation, but I should be able to take the money out and use it as much as I want to and however I want to. What you need to understand is this money isn't really yours, okay, in the sense of the only way you can get it out of the corporation is you have to pay yourself by having an employee, being an employee of your corporation, and you would give yourself a T4 or you would give yourself a dividend. So what you need to understand is anytime you just like go in and take money out of the corporation, you have to have a paper trail, and it has to at some point be reconciled with the accountant where they're paying you as an employee, which you pay taxes on, and then the rest is going to go as a dividend. So for example, if you like, let's say you make $100,000 paid to your corporation, but then you find like for your living expenses, you need the entire $100,000. Your accountant has to figure out how to get this out in the form of the T4 and the dividend to be most tax efficient for you. And so if let's say that you took out 100,000 and you had a T4 of 100,000, that would be no different than having a job. You'd have to pay full taxes on that. So a lot of times what we find is your accountant will set up your T4 income by a specific amount, let's say maybe 30,000, so that you pay less taxes as an employee, and then maybe do like a $70,000 dividend because dividends have a credit. So taxes are taxed at source. Dividends, when you take out a dividend, you're not paying full taxes on it. So I think that was Abby, that was your question, right? About the corporation?
Yeah. Yeah.
Yeah, so just really, it's your first year, right? Having a corporation.
Yeah.
You just have to you have to get like, do you have a good accountant that's like already taught you this and told you like how to take things out of the corporation?
I've been looking for accountants and I think I found one,
Okay.
but I haven't really had a conversation
Okay.
yet.
The reason why it's really, really important is because right away, as soon as you have a corporation, you're going to want to get a corporate credit card. Because I meet a lot of people and they basically, they have like their regular personal credit card,
Yeah.
which they'll pay for things on, and then they'll take money out of their corporation to pay the credit card, thinking, well, this was a business expense. I'm going to pay it off with my corporate money, right?
Yeah.
But that doesn't actually work like that because if you take out personal money to pay your personal credit card, even though it was a corporate expense, we have to figure out how to give that money to you, whether it's a T4 or a dividend when it comes tax time. So definitely get yourself a corporate credit card, okay, just so you can, pay for corporate things on a corporate card.
So I do have a corporate credit card that I use for like my business expenses.
Good. Good. And pay for as much stuff on that as possible. Like
Yeah.
you just remember, anytime you're paying yourself personal money, there's got to be a paper trail for it, and you're going to have to pay taxes on that in some shape or form.
Okay.
Okay. So get yourself an accountant. Now, the other thing that we do that I think will be supportive for you is we do a financial plan for you because when we do your budget, the budget will help us understand what is corporate expenses and what is personal expenses. And that way you get a better idea of how much you do need to be taking out of your account from a personal income standpoint. Okay. So I usually recommend you do that first and then you go over to your accountant because then you have more clarity about like exactly like what you're paying out for your stuff, right? So if you're interested in that, just let me know. We can do that, okay?
Okay, thank you.
Okay, no problem. And then it was, let me just see, it was you, Arbina. I want to go through the investment with you. So, you know, taxes, having a financial plan. I mean, the biggest thing we talk about is you need to know your three financial numbers. And I was going to go through an actual like how to create a financial GPS, but I do have a workshop on Monday night. I can give you the details for you. You can always come to that. I am going to address that there, but there's three numbers you need for your finances. You need a IPN number, which stands for income protection number. You need a DFD, which is your debt freedom date, and you need a financial independence number. Now, who here has heard about these? They know them. Anybody? Never heard of them before? Okay. Eurobina?
No,
No?
no, I've about it, my dear.
Okay.
It's the
So
first
basically,
time for us.
first time for
We've
that?
gone through it. We've
First
gone
time.
through it on here several
Yeah.
times. So.
Yeah, for sure. Minette saying like there are some recordings from the past. I have addressed it, but I'm just going to regroup. I'm just going to help you regroup. So income, when you're building a financial plan, just like having an address, you know, if I have an address to get to a location, I've got to have very specific address so that I get to the actual location, right? Well, when it comes to your financial plan, these would be the specific address to reach all of your goals. So the first one is your income protection number. This is kind of like while you're building your wealth, you always want to make sure that you have got a plan. So if we build a financial plan, it's very similar to building a big house, okay? So if we're building our house, the foundation would be built before the roof, correct? You want to build a strong foundation, okay? And that's basically, in this example, it's income protection, because think about right now, if you were not making income right now in your life, meaning for some reason you couldn't work, who would be affected? Would there be anybody affected?
You, like the person, like if me, I'm the one who's gonna be.
Okay, so you would be. So you would be affected by not making income. Anybody else in your life, Urbina?
Yeah, my kids.
Your kids, yeah, exactly. So kids would be affected. Okay. And when you make money, what does it pay for?
Your food and expenses.
Yeah, so like all of your like living expenses, right? And do you have any like debts or anything that your income pays for?
Yes,
Your debts, right? Do you have a spouse?
yes.
Okay, so your spouse. So when we think about the foundation of a financial plan, there is an amount of money that if I couldn't work, I would need. You know, like for example, if you bring in, say, $10,000 a month in income, then somebody would need to have $2 million, okay? Basically as income protection. Because if they receive $2 million in the event, let's say that I pass away, then I know my family is going to get $10,000 every single month just in the interest of that money. Okay. Now, how many people do you think actually know their income protection number? It's been explained to them like this. Probably nobody, right?
Mhm.
Because we forget, ladies, and I think there's a gentleman, that we forget our greatest asset. Okay, assets are things that we own. Our house is not our greatest asset. Our greatest asset is our ability to make money. Okay.
Mhm.
And a lot of you are travel nursing right now. You're making, you know, a lot more money. So think about it. Like travel nurses making $20,000 a month. You know, you're making $250,000 over 1 year, right? In 5 years, that's $1 million. That is a much higher increase than your house value. True? So we need to value ourselves. We need to really understand that, you know what, we insure our car because if something happens to our car, we want to make sure it gets replaced. You know, we insure our house because if there's a flood or a fire, we want to make sure it gets replaced. But we forget that we are the biggest asset to our life. So if our income isn't here, what's replacing our ability to make money? And that's a special number that's unique to everybody called your income protection number. So it comes down to like lifestyle. How much money do you want to leave for your kids? How long do you want to provide that income? How much debt do you need to make sure it gets paid off? You know, how long does your spouse need your support, right? And so that is something that in your financial plan, we need to calculate that. Now, a lot of times we have, you know, mortgage insurance. We have somebody sold us life insurance. We've got loan insurance or line of credit insurance. We've got credit card insurance. Like, if you think about it, so many different companies have started to try to charge us for all these different things that, and really what they're saying is income protection, but because each company is charging us separately, what do you think happens to how much money we're actually paying out? It's a lot more money, right? Like if I have 4 different people charging me for the same thing versus one charging me for the whole picture, it's going to be more money, right? Yes.
Yes.
Okay.
Yes.
So
Yeah.
okay, then let's talk about your debt freedom date, because you know your income protection number has paying off your debts. But if I pay my debts off, I don't need so much for my income protection number. But at the foundation of my financial plan, I do want to make sure I include it, but I also want to make sure I have a game plan to pay my mortgage off, to pay my line of credit, to pay all the credit cards, whatever it is, because every single month I have money going out to my debts, right? Now, if I didn't have that money going out to my debts, that would be a lot of money that I could focus on saving, true?
Yes,
So,
true.
yeah, and think about it. When you pay your debt every month, how many people actually have like a specific date? Like they would say to me, Jolene, my debt freedom date is June 20th, 2028, right? How many people actually walk around in life knowing their debt freedom date? They don't, right? So it's a question mark, but don't you think it's probably one of the most important dates of your life?
Oh yeah.
Yeah, because a lot of us are working right now just to pay debt. So knowing the date that we no longer have to do that, not to mention if there was a faster way to get there, wouldn't you want to know? Right? Like think about the Waze app. When you put an address in the Waze app, they'll say, "Oh, Jolene, there's an accident here. Take this route." They do a little detour, right? And it saves you a bunch of time. Well, when you have an actual financial game plan, it's going to say, if you do it this way, this is how long it's going to take you to be debt free. If you do it this way, here's how you can speed the process up. Now, everybody wants to know how they can speed the process up, right? Because ultimately, in your financial plan, the true destination, the place we all want to get to, the reason why all of you are on here today and you're working so hard is you want to get to your financial independence number. That's your FIN number. Now, I know that Bina, you're talking about investments and how does that work? Well, before even getting to the investments, most people walk around not knowing how much money they actually need to be able to live without having to work. Who on here actually knows their financial independence number? Anybody? Who knows their financial independence number?
I doubt anybody really does, except they do the plan, the financial plan.
Yeah. So imagine, right? Imagine this thing we call life. We're driving around in our life and we don't even know the destination. We don't even have the goal, right? And that's what I'm talking about. Like, that's why you need to know these numbers because, you know, you could get close, but you don't have any measure. And the thing about a human being is we feel happy when we're progressing. But if we don't even have a way to measure our progress, and we can't measure our progress if we don't have a definitive place that we're going. Would you guys agree? Like if you got in, yeah, like if you got into a car and it said, oh, it's a 17-hour drive and today I only drove 5 hours, well, then I'm like, okay, I got 12 hours left. So how am I going to do that, right? Like you start to become more confident with your decisions because you're empowered. You're like, okay, I know I got 12 hours left. I'm going to take this route. But in our finances, we just go to work every day. We pay our bills every day. A lot of you are making significant sacrifices every day. And then to not really be clear where you're going or how long it's going to take to get there, it kind of like when you think about it, it's like, wow, I really do need to know that, because the last thing that we want to know is, hey, do I even make enough money to reach the goal, right? And do I have a shortfall? That would be my biggest thing that I would say to you, is like, when you figure out how much money you need for your financial independence number through budgeting and getting out of debt and all those things, do you have enough money to reach the goal by the date that you want? And if you don't, how much more money would you need to make? And that's important, because we don't want to get to this thing called life and we get to that place where we want to be retired and financially independent and go, oh my gosh, I still have to work for 10 more years, right? That wouldn't be a great story, would it? So having said that, when you talk about this number, this is the destination, you need to know what the number is. You need to know like how much, and then we can get back to Yorubina, the investments, okay? And I did this at the last session, if you go back, and just creating what you want it to look like in retirement, okay? How you want to get there tax efficiently, because if you invest money, you know, we're going to talk about mutual funds and what's a stock and all that, Yorubina. I'll give you that just quickly so you've got some clarity on that. But if you don't actually preserve your money from taxes, you're going to give it all back to the government. And I don't think that's what you guys want to do, right? So when we're choosing investments, before we choose investments, we want to have a financial needs analysis, okay? That's the first step. That's so that we know our FIN number, okay? Step one. Inside of that, we want to know our budget. We want to know how much we need to save, and then we have to figure out if we have a shortfall, okay? And then we need to figure out the tax vehicles. Based on the income and how you're claiming it, we need to pick the vehicle. Do we TFSA? Do we do RSP, right? Do we do FHSA? So we need to know the different vehicles, which we did last week. So I'm not going to review. And then we do investments, okay? And so investments, if you want to understand investments, there's really only a few options, okay? And we'll talk about them. Now, a lot of people, they talk about Bitcoin and they talk about cryptocurrency. I don't talk about any of that stuff. It's just something that from an investment perspective, it's unpredictable, okay? So I want to work with you guys on predictable things that we can look back and see a trend, okay? If you choose to get into that other stuff, you know, my suggestion would be just don't do it with all of your investments. Maybe go take a little bit and play around, okay? Because you're curious. But you want to have a solid financial plan. So let's talk about what is a mutual fund, okay? So a mutual fund, essentially, Yorubina, because you're asking this question, think of a mutual fund as like, if I have like $100 and I want to get quality investments, there's no mutual fund like advisor that's going to like give time to somebody who has $100, because it's not enough money for them to put their time into it, so to speak. So what happens with a mutual fund is it's a bunch of individual investors, okay, that all pool their money together. So they pool money. And then what happens is they get a large amount of money. Let's say there's like, you know, I don't know, like $100 million in a portfolio. And then what happens is the mutual fund has a team of people, and that team of people makes decisions on the 100 million. Even though I'm only putting in maybe $100 a month, a mutual fund allows me to share the cost of having professional advising with a group of people, okay? And also having them making decisions about, you know, a large amount of money. Because when you have a small amount of money, it's sometimes hard to see your return on investment initially, okay? When you start to get $1 million and the markets fluctuate a little bit, you can really see like, hey, got to do this, got to do that, right? And so that's what a mutual fund really is. And mutual funds are based on, usually they say risk tolerance. Okay, so what I mean by risk tolerance is they might say to you low, medium, or high risk. Now, what I would tell you if you watch my previous workshop is if you do the 3 Ds of investing, you actually take away a lot of the risk, okay, from all of this. But low risk really refers to your allocation, okay? An allocation begins with fixed income. So if it's low risk, I'm going to say like a portfolio would look like 50-50. This would be 50% equities, which you're Urbina, also known as stocks, as opposed to just going into the stock market and buying one specific stock. It would basically be, 50% of this, I'm just going to call it F for fixed income. And this other 50% would be made up of probably like 100 different companies where you own their stock, okay? Now, the difference with a mutual fund stock, which also is called an equity, is that you're basically having a very small percentage, meaning if I have 100 different companies, then if one of the companies doesn't do well, there's a lot of other companies to offset that loss, okay? If I just go to the stock market and I buy a singular stock, if the stock price goes up or down, I'm going to feel all of the ups and downs, okay? Because I'm buying a singular stock. So this is what they would say, it's diversified, okay? Now at medium risk, this might look like it is, say, 30% fixed income and 70% equities. And then a higher would be like maybe like, 0 to 10% fixed income and 90% equities. So again, if you're talking to like somebody about mutual funds, this allocation, the percentage going to equities, it's always going to be, when you're younger and you have a longer time horizon, it's going to put you into sort of more aggressive funds because you have more time for those funds to actually accumulate and collect dividends and grow over time. If you're in retirement at the low one, you're actually expecting to create like a stable income. So you can't have a massive drop in your portfolio because you're collecting a set income from your investments. So Urbina, I just want to see if that helps a little bit understand mutual funds.
Yes, please.
Yes, okay. And I'm happy to meet you one-on-one because I would take you show you how to look them up online, like all that kind of stuff, right? Because we'll talk about what the fees are and how that works. But basically in a mutual fund, you're going to have a board of directors for one fund, okay? You're going to have one sort of professional person who heads up, like the leader of that fund. But what's good is they have a board of directors, so to speak, on every area of finance. So mutual funds tend to invest in all the different sectors, healthcare, industrials, financial, and you'll have a professional who has many degrees all inside of that sort of, when they're making decisions on the 100 million, everybody brings their data to the table and kind of like a project manager, and then explains it to the large group, and then decisions are made. So it's not like one person making decisions on your money, okay? So any questions about that, you guys? No? Okay. So a stock, I think I addressed what a stock is, right? A stock is just like you go on the New York Stock Exchange, or you set up like an investor account, and you're just saying, okay, I'm going to buy a Tesla stock. Okay. And you give them X amount of dollars, you buy X amount of stocks. Okay. So stocks are individually purchased. Now you take the risk in that because you're the one buying the stock, selling the stock. When you have a mutual fund, you sort of hand the risk over to the mutual fund advisor. That's like a hands-off approach, okay? We also have something called segregated funds. Segregated funds are like a mutual fund. The difference is they're sold with a life insurance license and they have a guarantee on them. So mutual funds don't have a guarantee. Segregated funds do, okay? They're also, they're creditor protected. So for those of you that are running businesses, it could be advantageous to have a segregated fund because it's creditor protected. So heaven forbid something happened in your personal, corporation and whatever. Segregated funds allow you to, like, if you claimed bankruptcy or you did a credit proposal or somebody sued you, when money's in a segregated fund, it's protected. It also bypasses probate, another great estate planning tool. So again, when we do your financial plan, if we determine that you could be at risk for, a proposal or being sued or any of that stuff, you're a business owner of sorts, we're going to talk about segregated funds as a potential option for you. But again, it starts off with understanding your personal situation so we can put you in the right direction, okay? Also, there's things you've probably heard of called GICs, which are guaranteed. You guys have heard of guaranteed investment certificate?
Yeah.
Okay.
Yeah.
So what you need to know about GICs will never outperform inflation. So if you put your money into a GIC, you'll never win the game of money because GICs are actually simple interest. Okay, so let's go to here, a GIC. So it's a guaranteed investment certificate, and usually it has a term on it, right? Now, you probably saw that the GIC rates went up a little bit, did you?
Yeah, this year and last year.
Yeah, and
They're
that's
like
because
5-6%,
that's right. And that's because inflation went up.
right?
Okay, that when the prime rate goes up, the GIC rate goes up. So like, mortgages are 6%, the GIC rate is 5%. When mortgages were like 2 or 3%, the GIC was like 1.5%. So what you need to know about a GIC is it is simple interest. There's no compounding interest. So simple interest, because what happens in life, so I'm going to give you an example, okay? I'm going to say that you invest $10,000. And we're going to say that, you know what, you got a 5% return on that, okay? Which is $500. Everybody follows? Now, inflation rate now, they say it's 3%, but it's actually 11. Because what they don't include in inflation is groceries, gas, and utilities, okay? So if the inflation rate is like, anywhere between 3 and 11, okay? What happens is money, if I have $10,000 today, and I'm just going to use a 5% inflation rate right now. So that means that this is only next year, that 10,000 can only purchase like 9,500. That's year 1. Year 2, it's going to purchase like 9,000. Year 3, it's going to purchase 8,500. So this is what happens with inflation. Inflation will naturally decrease the value of money. So anytime you invest money, you have to make sure you're outperforming inflation, okay? GICs will never outperform inflation because this is not compounding. You're not like earning, interest now on 10,500. You're always still earning that 5% on the original amount. So if you look, it didn't even do anything against inflation. And if you do have this in a non-registered vehicle, meaning you just set up a GIC and it's not sheltered from taxes, GIC is considered interest income and it is 100% taxable. Okay, so it's the least favorable way for you to earn on your investment because that $500 would get added. If I made $60,000 for the year, then the government would send me something called a T5, and I would have to claim that as $500 of income added to my income and pay taxes at my marginal tax bracket. Okay, so I'd have to give back 30% to 35% of that $500. So I actually, after inflation and after taxes, I actually have like basically no money. Okay. So I'm just going to I know we're at our 3:42. We always say 45 minutes, but as you can see, like money has there's a lot to it. Okay. But I still always really say to you that you really do need to start with a financial plan first. You're not obligated to anything, but it'll give you the clarity that you need so that you can go in the right direction to find the next steps. Okay. So any questions, Urbina, or did that support you?
Yeah, that's fine. I understand.
Yeah. What's one thing you took away today, Urbina?
That the segregation type, you were able to differentiate between the segregation one and the
Mutual
in
fund?
the ordinary. Yeah. So
Good. And you know what you can also do, Urbina? I love tools, but you can just Google mutual fund versus segregated fund, and there's a side-by-side comparison that's really good for you too.
oh, good. Okay.
Yeah, and I'm happy to send that to you as well.
Oh, okay. Thank you.
Yeah. And Urbina, you haven't scheduled your financial plan yet, correct?
No.
Okay. It definitely, here's my number. You could text me.
Sure.
You would definitely benefit from that because a lot of your questions are really good and it's going to help me be able to give you the right direction.
Okay.
Okay. Abby and Vincent, any questions or do you want to share a takeaway from today?
I was wondering if there will be more like workshops about like corporations, or if I had any more questions, like would I be able to like, contact you?
Yeah, absolutely. So Abby, you can contact me for any of the financial stuff. So take my number and send me a direct text so that I can put you in my database. And then on Fridays, Minette has she has 2 accountants that come out and specifically speak to the taxation questions.
Okay. And so I am working on Friday. Are those meetings recorded?
They are, yeah.
Yeah,
Okay.
they are, which
Oh,
is
okay.
good.
Yeah,
Okay.
and so you're able, Abby, if you text me now, Abby, I'll make sure that we get you on the list to make sure you know where to find the recordings, okay?
Thank you so much.
Yeah, you're very welcome. Did you have something you took away today?
Mhm.
Yes, learn more about corporations and like about the credit card for sure, because I
Yeah.
do have a credit card and I try to continue to use it. And yeah, it is a little confusing, but I feel like I got more clarity.
Okay, good. Yeah, good. And you can even direct message me your contact information, Abby, and I can get you out there. I do have a book called How Money Works I send everybody. So if you send me you can text me or email your phone number and I'll get that out to you.
Sounds good.
How about yourself, Anne?
Oh, I got a lot of clarifications with regards to the GIC, and I'm actually looking into corporations as well. So it is really informative. Thank you so much.
Yeah, you're very welcome, Anne. And like I said, feel free to send me a message and I'll get you that the booklet.
For
And then,
sure.
and also, like I know you have the question about the being employed in one province and then going to another. Depending on how your income went, you do need to talk to an accountant about that, because especially Quebec. Quebec has a lot of different tax rules.
Yeah.
And
Right.
you are gonna have to find an accountant that actually they have to have a special like registration to do Quebec taxes. So I know ours does. I know that Tanya, who comes on Fridays, she is able to do taxes in Quebec. So
Okay.
Even Ida too is
and
based in
Ida too.
Quebec.
Okay, good. So that'd
Ida
be
is actually based in Quebec.
even
Oh,
better. Yeah. So Anne, are you on the travel nurse group, Anne, or a separate group?
I am. Yeah.
Okay, good. So then you're gonna see the information for that workshop on Friday, okay?
Awesome. Thanks.
Okay, very good. Excellent.